I think it's quite hard to generalize. So if you talk about capital from China, for example, one Chinese insurance company is not necessarily pursuing exactly the same strategy as another one. So I think if you're targeting capital sources like that, then you really need to build those individual relationships and find out really what their drivers are and what they want to invest into. That said, I think that investors, as they go overseas, tend to be conditioned by their own domestic experience of returns, which means that, for example, North American capital has had, a very good run domestically over the past few years. They tend to be higher risk investors. So Europe has been a fertile playing field for them in the past few years. I think one of the things we're starting to sense from some of that North American capital, though, is a little bit more maybe a realism about the returns that can be generated going forward at this stage in the cycle, and a bit of a fledgling interest in more core strategies when they do go overseas, both into Europe and both into Asia. So I think that it's hard to generalize too much, but I do think there is a little bit more realism about the types of returns that can be generated at this point in the cycle.
Well, the parties we speak to are certainly focusing on the top 7 cities in Germany or the capital cities in Europe. I think they will shy away from B cities. They still shy away from value-add or opportunistic products. So it will be quite difficult for them to compete with the domestic peers, because the domestic peers are usually a bit quicker and they already realize that the yields have come down and they have to pay a pretty rich price.